Good evening. Welcome to the second quarter results update of Het National Bank. Hope everybody can hear me. I'll start with going through the presentation and taking you all through the numbers for about 10 minutes, and then I'll open it up for questions. Starting with the P&L, as you all can see, we have had a fairly good growth in NII, 17% at a group level. Net fee income grew by 3% to 4.9 billion. Net insurance premium, there was 11% growth to 3.9 billion. Other income, you see a significant drop. That was as a result of the appreciation of the rupee in the first 6 months of this year compared to the depreciation of 3% that we witnessed in the first 3 months of 2018. And then impairment, which we witnessed a significant growth during this year compared to last year. But I was also, what I was mentioning just before I paused was that if you compare the two quarters, the first quarter of 2019 and the second quarter of 2019, you would see that there is a significant improvement in impairment in the second quarter compared to the first quarter, and you will also see a similar trend in NPAs as well. So overall, at a group level, net operating income went up to 31 billion, which is a marginal growth of 0.4% compared to last year. So overall operating cost or operating expenses for the group grew by 19%. Now this 19% increase is to an extent overstated, as I mentioned in the first quarter results update as well, due to increase in expenses that was recorded by HNB Assurance. This is actually not an increase in expenses in HNB Assurance. Last year, if you all remember, insurance companies, there was a change in tax regulation. So as a result, the insurance subsidiary booked their profits in the first quarter. Now, normally you would know an insurance company does their shareholders funds valuation only in the last quarter and bring in the profits in. But because the tax regulations are changing, they actually did it in the first quarter and brought in or they recognized the profits coming from the life fund into the P&L. So that is actually having an impact in terms of an operating expense being reduced in the first half of 2018, which of course did not happen this year, because this year the life fund will be only revalued in the last quarter. So therefore this 19% increase is kind of an artificial increase, which you would probably, or it will get normalized at the year end. So profit before VAT and tax overall has come down by 17% as a result of the higher impairment that we witnessed, and as I explained in the previous slide. Total taxes have gone up despite profit before tax and VAT coming down by almost 3 billion. So as a result, we see a 38% drop in profit after tax and profit attributable to shareholders at 4.9 billion. So at a bank level, you'll see the similar trend like in the group. NII growth has been 18%, which is a fairly commendable performance given the current situation where the loan growth has really not, we haven't really witnessed a loan growth at all. It's actually a negative growth compared to where we were in December, but a slight growth compared to June 2018. Net fee income is more or less flat, though we would have expected it to do much better. I think compared to some of the other banks, I think we have done quite okay in terms of net fee income, which some of the other banks have witnessed a drop in the first 6 months. Again, other income I explained earlier. The drop is mainly due to the rupee appreciation in the first 6 months of this year compared to depreciation last year. Impairment has almost doubled to 6.3 billion, again because of NPAs rising, but trend has kind of reversed in the last 3 to 4 months. Then going into operating expenses, now you would see that 19% group at a group level is significantly come down to 13% at a bank level, and even this 13% is mainly due to last year April being a collective impairment year, so the salaries of non-executive staff increased in April of 2018. So for this year, that increase is there for the full 6 months, while in 2018 it was only there for 3 months. So that's why the increase. So we are managing our expenses fairly well, despite significant amount of investments that are going into digital and IT infrastructure as well. So overall, profit before VAT and tax at a bank level has also come down by 14% to 12 billion, again, mainly as a result of high impairment. And total taxes have gone up by 8% to 7.2 billion, again, despite profit before VAT and tax coming down. You would see the VAT and tax levels have gone up again, mainly as a result of the new debt repayment levy that was introduced towards the latter part of last year. So PAT for the bank is at 4.8 billion, a drop of 34% for the first 6 months. So this is the waterfall chart which shows profits moving from 7.8 billion last year to 4.9 billion at a profit attributable to shareholder level. So a main plus has come through an increase of NII of 4.3 billion. And also a small plus coming from fee income, but being eroded mainly by impairments and provisions, and also the operating expenses, which I mentioned earlier. Even at a bank level, you see that again NII contributing significantly, but the provisions have kind of eaten into the increase that we witnessed in the NII. So at a DuPont analysis level, you see that NII as a percentage of average assets, or more or less the margin of the bank, has improved. NII as a percentage of average assets remain at 5.11. It's an increase from 4.83, which we witnessed last year. Other income to average assets have come down because there is a drop in exchange income, again due to the FCBU accumulated profits getting revalued at a lower rupee value. Then impairment has gone up significantly to 1.23 compared to 0.73 we witnessed last year. So this has improved from the first from the first quarter, which was around 1.66. Now it's down to 1.23, but still there is a lot more improvement that we expect to gain from impairment in bringing down the credit cost. So operating cost at a group level stands at 3.17, slightly gone up from 2.97 from last year, and taxation at 1.4% as a percentage of average assets. So the main drivers of ROE would be driving other income of 1.55. We expect to drive this up. And also in terms of credit cost, which is at 1.23, is something that we want to bring down. So those are the two key drivers that we are looking at in driving ROA, which is at 0.9 at the moment. And of course, with uh, with the situation improving, with expected with credit expected to grow maybe starting from next year, we also would expect the leverage multiplier to improve, and that would also provide more leverage into driving the ROE numbers. So this is at a bank level. Now at a bank level, you see that the leverage multiplier is starting to improve from 8.83 what we saw last year to 9.19. But however, with credit growth happening, we would expect this to improve further, driving ROE. But the bigger concern is taking ROA back to the 1.7, 1.8 levels that we have witnessed through driving down impairment cost, through improving other income to average assets, and also consequently bringing down operating cost to average assets. So these three levers will be the main drivers of ROA and thereby driving ROE. So the group companies also have shown a decent performance. HNB Assurance, again, it's been a tough year for the group companies as well. HNB Finance has also had its own MPA issues. Operating in that particular segment is not easy when the environment is not that conducive, but they have managed to report a PAT of 337 million for the first 6 months. And also insurance company has done a 288 million. And as you would know, insurance profits actually, especially on a life insurance book, the profits actually get reported only in the last quarter when you do the valuation of the life shareholders fund. So again, equity has also reported fairly good results, 165 million for the quarter, despite stockbroking not contributing too much, but the primary dealership operation has actually contributed fairly well. So I mentioned about strong co-banking performance, NII is improving, fee income growing. The loan book of the bank remains more or less same as what we have witnessed last year. Retail is 22%, SME and micro at 31%. Mid-market is at 4%, and corporate at 43%. So not a significant change in the loan book, maybe a slight drop in the large corporate portfolio and more tilt into probably the retail and the SME, but not a significant change. So in terms of non-funded income, main contribution comes from fee income, and then you have the insurance contributing as well as, NII being the main contributor. Out of the non-funded income, you see fee income at 13% and insurance at 10%. The other is mainly the contribution coming from exchange income, and especially this particular year, we haven't had significant contribution coming from exchange income, as explained earlier. So fee income is a main contributor is cards, ATM, and digital banking. Trade also has contributed its fair share of 19%. Cost to income ratio, you see that over time we have been able to bring down cost to income ratio down significantly. It's started going up slightly as a result of more income growth tapering off as a result of fee income not growing as much as expected, and the contribution from exchange income not coming through in this quarter as a result of appreciation of the rupee. However, we are hopeful that we will be able to continue the drop in cost to income ratio that we have witnessed with all the efforts that are going into digitalization, the operational excellence, the process re-engineering that is being done. That we are hopeful of bringing down cost to income ratio below the 35% that we have been targeting. In terms of asset quality, I think this is probably one of the most important slides from March, where we saw a significant surge in non-performing loan portfolio, especially in SMEs. We see that it's kind of tapered off since, and we see SME NPAs have also come down. Corporate NPAs have also slowed down, and so has the overall NPA portfolio. So it's a good sign to see that despite the environment challenges still remaining, because of the focus that we have maintained in collection, in ensuring that the recoveries are done at branch level, at the center, we have been able to bring the NPA issue under control. So I think we probably would be the only large bank that has witnessed NPA levels remaining at the same level compared to the first quarter, while most of the other banks and the whole of the industry has witnessed NPAs rising even in the second quarter. So capitalization, as I mentioned earlier, we are strongly capitalized. Our tier 1 is at 13% compared to a 10% regulated requirement. So we don't see a requirement to go in for tier 1 capital in the immediate future. But however, in terms of total capital, tier 2, we might be coming up with a debenture issue very soon to buffer up our tier 2 capital. So again, I think I mentioned about taxes and how taxes have gone up despite profit before taxes coming down from last year. And you see a breakup here where the main contributor to effective tax rate going up from 48% last year to 60% this year is the debt repayment levy that we witnessed coming into effect from latter part of last year. So that's contributed to about 10% of the overall effective tax rate going up. So in terms of loan book, our concentration this quarter was mainly in terms of recoveries, ensuring that we bring asset quality under control and we cleanse our portfolio and ensure that our portfolio is in good standards. So as a result, growth took a backseat, and we have not seen too much of a growth happening this quarter or this half. So the loan book actually had a negative growth of about 3% from December, but overall compared to June last year up to this year, we see a loan book growth of 4% and a deposit growth of 7%. And even in the industry, you'll see that the private sector credit growth has more or less been flat during this year. So share price witnessed a drop in the early part of this year, but during the last few months, we have seen a surge in share price. Even with the increase in the share price in the last few months, still we see that the share is trading at a fairly deep discount to book value at just 0.5 times book value. So still remains fairly attractive. So that's the presentation. With that, let me now open it up for any questions.